Realty used in the trader business. Help, help. It's 1231 subdivision. 1231 asset subdivision, which includes building and improved parking lots. 1250. Oh, jeez. Had to wait so long to get that response. Thank you, Margaret. Okay, a 1250 asset. So for an individual selling a 1250 asset, 3 tiers of gain. What is tier 1? Tier A. What is tier A?
Depreciation recapture.
What's the recapture for tier A? Tier A and B are both recapture.
Oh, the excess over the excess accelerated over the straight line.
That is correct. The excess of accelerated over straight line depreciation, Barry, those should be in one of the handouts I gave you. That's tier A, and you will compute that because this will have been an acres barn and he took accelerated. And they'll tell you, this one they'll tell you what straight line would have been. Then we have tier B. What was tier B? This was the one that I call reduced rate 1245. The official name is unrecovered 1250. Go ahead, Donna, go ahead if you had that open.
I can't read my notes.
Oh no! Barry, do you have that handout? Has the building at the top I just gave you?
It's the total depreciation minus the depreciation recapture.
That's right. Donna's found it, the total depreciation minus the recapture in tier A. Do the computation. You now have tier A and tier B. You will look at them. Tier A plus tier B, which are the total depreciation recapture, cannot exceed what? Cannot exceed, that's right, the total gain recognized. If you get Zeke, not all of you will get Zeke. You did tier A, as Don explained, you did tier B, as she explained. You then look at A plus B, and it's too much. The total recapture cannot exceed the total gain. So you'll need to redo tier B. You'll need to redo tier B so that B plus A equals the total recapture. So your official answer should read a certain dollar amount that you'll fill in, taxed at either 35 or 39.6%. A certain dollar amount taxed at either 35% or 39.6%, and another dollar amount you'll put in there, taxed at 25%. Taxed at 25%. But do tier A and B, first of all, the way my handout showed. Then you'll have too much. So you're going to plug tier B. So A plus B does not exceed the total gain. But identify each tier separately. Tier A is taxed at 39.6 or 35. Tier B taxed at 25%. Okay, the third possibility, this is what we talked about last week as well. A corporation sells a 1250 building. They're selling an apartment building, that would be a 1250 asset. We want to know the total depreciation recapture. Now there are 2 tiers of recapture. Donna, you're our specialist here now. What are the 2 tiers of recapture for a corporation selling a 1250 building?
The excess accelerated over the straight line.
That's right, that's tier A. Everyone in tier A has excess of accelerated over straight line, and that will occur here. And tier B?
The 20% of straight line?
That's right, 20% of straight line, that was that section 291. Now, we talked about this last week, but we have a chance to talk about it tonight as well. And we said, but Bill, straight line depreciation is not going to be given, nor do we know the life to be able to compute it. Well, what do we know? We know what the accelerated depreciation was that was taken. That will be given. But there's a line in the problem. Why don't I read it to you slowly so you can actually write the line down? The recapture rules applicable to trusts and estates, the recapture rules applicable to trusts and estates require that, I'll even give you the dollar amount, I feel generous, because I know the other people are going to do the survey for me. Okay, require that $9,000 of the gain, $9,000 of the gain be listed as ordinary income. $9,000 of the gain be listed as ordinary income. Bill, could you please repeat that? Yes, I can. The recapture rules applicable to trusts and estates require that $9,000 of the gain be listed as ordinary income. With that handout in mind, what would that $9,000 represent? Remember that handout that showed trust and estate in the middle? Remember, trust and estates had two tiers of gain. What was tier A? They only had one tier of gain.
Recapture.
But what was the formula?
Excess of accelerated over straight line.
Excess of accelerated over straight line. So if we're saying the recapture for a trust or estate would be 9,000, that means 9,000 is the excess of accelerated over straight line. Everyone see that? The 9,000 would be the excess of accelerated over straight line. So if you know what the accelerated is, and you know what the excess of accelerated over straight line is, what can you back into? Yes, straight line. Exactly, you can back into straight line. So for this problem, take that 9,000 plus 20% of straight line. Barry probably doesn't know what we're talking about, because that's, you got to study that handout on recapture. The book's not going to help you enough. It should be in that bundle I gave you, though. Okay, everyone set? A little trickier, but, you know, if you're ready. Other questions on that problem? All right, please do well. Sometimes that problem has not gone as well, but in the past, we didn't have that much time to go over the final exam review. That's one reason I'm not complaining about a week 8 this time. All right, problem number 3, all 3 versions are similar. This is one of the ones I put in. We have a corporation put into service on March 15th, some 7-year property, and on December 1st, put into service some 5-year property. So we have property put in service in the first quarter. It happens to be 7-year property. Property put in service in the fourth quarter, which happens to be 5-year property. There's a Part A and a Part B. In Part A, the mid-quarter convention is going to apply. In Part A, the mid-quarter convention is going to apply. Because, what was the mid-quarter convention test? Anyone remember?
45%.
40, close. That's right, if more than 40% of all the personal property, that's 3, 5, 7, 10, 15, 20, is put in service in the last quarter, mid-quarter convention applies, and in Part A, the mid-quarter convention is going to apply. I want you to depreciate both the 5-year property and the 7-year property for 2014, and then depreciate them for 2015. Now, this is like what I had on the board, except there is no what? Remember, I had examples on the board, but there's no sale or disposition. So you will not be using 12.5, 37.5, 62.5, or 87.5% because these are not disposed of. Now, for Part A, for the March 15 property, you will have to use Table 2. Remember Table 2 in the handout because that's Makers Mid-Quarter Convention First Quarter Property. Table 2. For the December property, you will be using what table? Table 5. Table 5 because Table 5 was mid-quarter convention, property put in service in the fourth quarter. So you have two computations for 2014, one for 7-year, one for 5-year, and two computations for 2015, one for 7-year and one for 5-year. There is no sale or disposition, so there is no 12.5, 37.5, 62.5, or 87.5%. In Part B, I say, what if all the properties had been put in service on March 15th? What if all the properties had been put in service on March 15th? Depreciate them, again, 4 computations, the 7-year property and the 5-year property in 2014, the 7-year property and the 5-year property in 2015. Now, if all the property had been put in service in March, what convention is now applying? Half year. So everything will be in table number 1. Table number 1. And again, you don't take this times 50% because there's no sale or disposition. That's usually done pretty well. Any question on that? That should be easy points, I hope. Set. Right. Problem number 4, this is theirs. There's two versions are similar. The other version is a little different. I'll give you the one that's a little different. This is essay. Briefly describe what material participation is. This is possibility 1, problem 4. Briefly describe what material participation is. Why is the determination of whether a taxpayer materially participates? Why is the determination of whether a taxpayer materially participates important? So briefly describe what material participation is. Remember we had about, 7 tests or something for that? And why is the determination of whether a taxpayer materially participates important? The best place to look for that is probably that handout I gave you from the U of I tax school. Remember we had that handout that dealt with something else that's going to be on the exam coming up later, the rental real estate, $25,000. So look at that thick handout. And prepare an essay answer in advance of entering the exam that you could just, place right in there. The other two versions are differentiate. This is not parts. These are the other two versions of problem 4. Differentiate between the following. And this one you know. Active income, passive income, portfolio income. That's strictly essay. Everyone set for that? Okay, now, the next one is their problem also. Says it's individual. They give a bunch of items. Analyze the above expenses. Analyze the above expenses and determine which ones. Analyze the above expenses and determine which ones are deductible for, put it in capitals, FOR, for AGI. Then it says, please support your position, but I'm not going to ask for support. So they're going to give you like 7 or 8 expense items. But they only want the ones which are deductible for AGI. So they don't want the itemized deductions on Schedule A. What are some items that we discussed that were deductible from gross income and arriving at adjusted gross income? What are some of the items? Think of the 1040, page 1, the bottom part. What were some of the items? Student loan interest, excellent. Amy, yes. Student loan interest. Okay, yeah, that's right. Well, remember, you learn a lot on the job type thing here, and that's true. And that's one of the possibilities here, yes. What's the one that said, list recipient's social security number? Alimony pay, yes. Alimony pay, that's another one. What else? Think about that area of the 1040. How about contributions to pension plans, IRAs and stuff? Simple, SEPs, KEO plans. So all those contributions to IRAs and other retirement type plans. One that maybe you would know, we mentioned it earlier tonight, moving expenses. Remember, we said the moving expense reimbursement is automatically picked up in your employee's income, then you offset the deductions. Now this is good, because even if you did not itemize, you could still offset the moving expenses because they're not an itemized deduction. They're deductible in arriving at AGI. You ever heard the expression above the line and below the line? Above the line means items that are deductible for AGI. Below the line means items after AGI, which are itemized deductions. So I don't think that one will be bad. And you don't have to support your position, just list the ones that are deductible for AGI. Bill, we want another one of yours, I hear you. Problem number 6. Now, this shouldn't be bad. This is a problem dealing with depreciation of makers' real property. Depreciation of makers' real property. Now, one of these is easier than the other two. One of these says, the person purchased and placed in service residential rental property. residential rental property. Now, under makers, what is the classification of residential rental property? Is it 27.5 or is it 39? It's 27.5. I think it was table 7. Don't hold me to that. My recollection is it was table 7. They want you to depreciate 2014 and 2015 to start with. Remember, I think you're using table 7, if that's the 27.5-year table. Remember, there were column headings that were based on the month in which the property was put in service. Now, in 2016, there's going to be a disposition. There's going to be a disposition. So that, of course, means that you'll take the normal depreciation. Now remember, for example, if it said 3.636, that's 0.03636. Remember how that works. And take that times something 0.5 divided by 12. Remember, there's a mid-month convention. There's a mid-month convention that applies here. And we need to remember the mid-month convention. The mid-month convention. So 27.5-year property for that one. Depreciate year 1, year 2, using table 7. Then, in year 3, do the regular depreciation, but then when it's disposed of, something 0.5 divided by 12. Something 0.5 divided by 12. So let me provide guidance. If it were disposed of on July 13th, it's deemed to have been disposed of July 15th. So what 0.5 divided by 12? Is it 7.5 divided by 12? 6.5, excellent. Excellent. What would be 7.5 divided by 12? August, yes. Okay, so that one, perfect scores. Now the other one. And I'm going to do something on the board here. The other one, you don't know if it's 27.5-year property or 39. You'll have to do the 80% test. Anyone tell me what the 80% test is? Anyone remember the 80% test? If more than 80% of the gross rental income is income from dwelling units, then it's 27.5. What if it's not from dwelling units? Then it's 39. Let's say we have some stores. We have a building with stores and also apartments. Stores, the rent would be $20,000 a month on all the stores. We have apartments, and the rent on the apartments is $10,000 a month. Now, apply the 80% test. Take 80%. Now, the combined rent is $30,000. Notice I'm choosing easy math. 80% of 30 is 24,000. So if the rent from the apartments exceeded $24,000, this would be 27.5-year property. Does the rent on the apartments exceed $24,000? No. Thus, this is 39-year property. Because basically what we're saying is that this property is predominantly commercial property. So if that happens on the exam, you'd be using Table 8A. Table 8A, which is the 39-year property table, if my recollection is correct. So you know on the exam it'll either be 27.5 or 39. Do the 80% test. Then this problem wants you to depreciate year 1. And then in year 2, there's a disposition. The disposition in year 2 on both of these is March 2nd. March 2nd. So that would be what, March 15th? 1.5 divided by 12? 2.5, right, 2.5, very good. So that really shouldn't take that long, that one. Questions about this 80% test? All right, problem 7. This is one of theirs from Becker. Basically, all 3 versions want to know how much rental losses, bless you, how much rental losses may an individual deduct? How much rental losses may an individual deduct in determining taxable income? Now, let's talk more about this. Let you write that down, because we're just relaxing here tonight on Monday night. We're not used to coming on Mondays. Remember, we're not coming on Thursday. Unless you want to come and go into the lab and take the exam. Now, that handout that I gave you from U of I Tax School that we talked about material participation, remember we looked at the end of that handout and it talked about how there was a $25,000 mom and pop rental loss deduction exception. 25,000 exception, but the exception is phased out. The exception is phased out for AGI between $100,000 and $150,000. $100,000 to $150,000. It's phased out 50 cents on a dollar. So that's why it goes to one. At $150,000 of AGI, you would not be able to use any of the mom and pop rental loss exception. At $100,000, you could use the whole thing. So take a look at that. they're gonna have you somewhat in between the $100,000 and the $150,000. I notice all three of these possibilities. One of them has an AGI of 120,000, one is 130,000, and one of them is 140,000. So some of that phase out will apply. So they have this, they attribute this to Becker, but also it's in that handout that I gave you as well. There's another Becker problem coming up too. Now, we didn't do a lot with that in class, although we did look at the examples in the handout. So it's that thicker handout on passive losses. I think it's that chapter 4 or something. It's from the U of I seminar last year. Any questions on that? Up to $25,000, phased out 50 cents on the dollar for AGI between 100 and 150,000. I think people are looking overwhelmed right now. The last problem that I added is number 8. And then 9 and 10 are theirs. In number 8, we've been talking a lot about depreciation, so one of the possibilities, so probably only 1/3 of you will get this. It's a shame not everyone would. We have a calendar year taxpayer bought a machine with an ADR class life of 18 years. ADR class life, what are you talking about? Remember in that thick handout, I think we looked this up. We said a class life of 18 years, I think was a maker's life of 10 years. Someone can reconfirm that. Remember, it gave the definition of a 10-year property. Property with a class life, I don't know, 16, oh wait, please read to us. Amy's got documentation here.
I think this is correct. Generally, 10-year property is property with a class life of 16 years or more. In the third section. It's less than 20 years.
16 years class life, that's the ADR class life. So between 16 and 20 years, 18 falls in there. Thank you, Amy. So basically, this will be 10-year maker's property. 10-year maker's property. Okay, the machine, I'm even going to give you the number. Bill, you're giving us too much. $2,100,000. $2,100,000. And he wants to get the maximum depreciation. Now there's 3 parts and they're not weighted equally. Part A, what's the largest depreciation deduction allowable for 2014? By the way, it was put in service in November 2014. Put in service November 2014. Wait, if it's the only thing you put in service, and it was in November of 2014, what convention is going to apply? What convention? All the property put in service was in the 4th quarter. Mid-quarter. Now, we had some examples on the board, only we had half-year convention, but very similar. We had an example with $2,200,000. We had an example with $2,300,000. This is $2 million what? 100,000. First thing is the 179 deduction. Yeah, I can picture it now. 2,000,001 minus 2 million is 100. Excuse me. 2,000,001 minus 2 million is $100,000. So that's the phase out. What was the maximum 179 again? Maximum 179 amount from Bill's examples? 500,000 minus the 100,000 phase out means your 179 would be what? 400,000, wouldn't it? Well, take a look at the notes. Although that was half-year convention, this is mid-quarter, the beginning operates the same way. Now, looks to me like off the top of my head that we could get a $400,000 179 deduction. So 2,000,001 minus the 400,000, that gives us a subtotal. We also want to take bonus depreciation. What's the bonus? What's the bonus depreciation? What's the bonus depreciation rate? No one remembers the bonus depreciation rate?
50%.
50%. Saved by Donna. 50%. That gives you the bonus depreciation. Then you need to compute, remember we had examples near the silver band of the board. Then you need to compute the depreciable basis. Well, this is a hell of a lot of work, sorry. Take the 2,000,001 minus the 179 minus the bonus depreciation. That's your depreciable basis. We had 2 examples in class. 2,000,001 minus 179 minus bonus. That's your depreciable basis. Now, regular depreciation year 1 would be your depreciable basis times, now here you have to go to table 5. Table 5. 10-year property, year 1. Amy's even got that. Let's let her look it up for us. 10-year property, table 5, year 1. 2.5, that sounds good to me. Everyone can reconfirm that on their own. So take that times the depreciable basis, add back the 179, add back the bonus. Woo! Finally, year 1 depreciation. Do we need to reiterate this? Does this all sound like Greek hieroglyphics or Egyptian hieroglyphics? Well, let's go through it real quick again. First of all, we want the maximum depreciation year 1. This is for part A. This is the hard part. Then we have 2 short parts. So we're going to start off with the 179. 2,000,001 exceeds 2,000,000. That's the statutory amount by 100,000. We're small business, but we're not entirely small enough. So then we have 500,000. That's the statutory maximum minus the 100,000. 400,000, 179 deduction. Now we're going to take the 2,000,001 minus the 400,000, that's what, 1,000,007, times 50%. That's the bonus depreciation. What's that, 850,000 or something? I'm doing math in my head, don't trust me. Then you'll compute depreciable basis like we did on the board. The 2,000,001 minus the 400,000, 179, minus the bonus, which was something like, about 850,000, but don't trust my math. That's your depreciable basis. Then, regular depreciation year 1 will be that depreciable basis times the table percentage that we got from Amy. That was table 5, 10-year property, year 1. That amount plus the 179 plus the bonus is the answer to part A, the most significant part. Now in part B of that question, part B, if he sells the machine on December 30th, 2015, if he sells it the next year, December 30th, 2015, how much depreciation in 2015? Now that would be, again, that's just regular depreciation, but now we need Bill's numbers. That would be table 5, 10-year property, year 2. Table 5, 10-year property, year 2. Take the percentage times the depreciable basis. But it was disposed of December 30th. Which quarter is that in? Which? Fourth. So it's deemed to be November 15th. So you will take that, for the third of you who get this, times 87.5%. 87.5%. Because you'll be depreciating January 1st through November 15th. That's part B. This is the longest problem on the exam. The other versions are long too. Part C. Assume he bought the machine from his wife. What's the largest depreciation deduction for 2014? Bought it from his wife. Related party, isn't it? Isn't it the related party rules? Related party rules. Now, if it's a related party, no 179. No 179. But you can get bonus and regular depreciation. So you would start off with what? 2,000,001 times 50%. 2,000,001 times 50%, what's that, 1,050,000? And 1,050,000 will be his depreciable basis. And then, of course, you go again to table 5, 10-year property, year 1. Doesn't talk about any disposition for part C. Questions or ideas about that challenging problem? Well, before you pray you don't get that one, the other two versions of problem 8 involve section 351 from last week. Remember that spreadsheet we put on the board? Okay, let's talk about this because 2/3 of you may get this area. This will give you a good experience for the CPA exam because it's having the same level of. We have Mr. Green and Mr. Brown forming a corporation. Mr. Green is going to transfer to the corporation some cash. Mr. Green will transfer to the corporation some cash and properties A and B. Properties A and B. They give you the fair market value of property A and its basis. They give you the fair market value of property A and its basis. They give you the fair market value of property B and its basis. They give you the fair market value of property B and its basis, and it's also subject to a $25,000 mortgage. Subject to a $25,000 mortgage. Let's repeat about Mr. Green. He's transferring to the corporation cash and properties A and B. They give us property A's value and his basis. They give us property B's value and his basis, and property B was subject to a $25,000 mortgage. Mr. Green, that was Mr. Green. Mr. Brown, that was Mr. Green. I'm getting my men confused. Mr. Brown transferred to the corporation cash and property C. cash, and property C. And they give us property C's value. They give us property C's value. His basis in property C. His basis in property C. And it was subject to a $150,000 mortgage. It was subject to a $150,000 mortgage. Now let's stop a second here. First of all, there is no boot here. There is no boot. So the only possibility for a taxable gain would be if there were liabilities in excess of the basis of all the property transferred by that taxpayer or by that shareholder. So there would only be a taxable event, a taxable gain, if the liabilities exceeded the basis of everything that shareholder contributed. Hint, for Part A, we want to know, is there any gain or loss on any of the transfers? If so, to whom and how much? On one of the gentlemen, whether Mr. Green or Mr. Brown, there will be no taxable gain. On the other one, there will be a taxable gain because of liability exceeding the basis of everything he contributes. This was similar to an example that we had on the board last week. I think it was the hypothetical shareholder E. We also had it in George. That's Part A. Part B, what's the basis of each shareholder's stock in the company? What's the basis of each shareholder's stock in the company? Remember, we had that again in our spreadsheet that was on the board. If your computation comes out to be negative, you've got an error. It can never be negative. It could be 0, but it cannot be negative. And then Part C is determine the basis of each property in the hands of the corporation. Determine the basis of each property in the hands of the corporation. And you can combine property A and B together. So it could be property A, comma, B. And then determine separately the basis of property C. If you follow my spreadsheet that we had on the board last week, over on the left side, for shareholders B, C, and D, we also made a hypothetical shareholder E, and we did George. That should be enough. Now, on the exam, there's that little box. You will not have room to put that whole spreadsheet in, or I will never be able to read it. So all you need to do here, do the spreadsheet, and then just put down the final answers in the box. Just the final answers. Because I remember I had students try and do the spreadsheet in the box, and I couldn't read it. It was unreadable because it puts it in sentence form. Any questions on that 351 stuff? Now, Barry's going to need some guidance on that because, although have you viewed the taping?
I haven't viewed the taping, but if anybody has pictures of the board, that would be helpful.
Yes, please could you email those or share those with Barry? Because that you really need that. Now you'll have the handout. You won't have, well, yes, if you got the picture of the board, you'll be set for that. Well, someone be nice to Barry, please. He helped me out by signing up for the course as well as Lena, so please help him on my behalf. And if you want to let me know you helped him, then you get brownie points with me. You tell me I sent a copy of the board photos to Barry. Because I think that will be essential for that. Other questions on 351? All right, let's do the last two problems. These are theirs. Problem number 9 is from Becker again. It's not bad. They want to know an individual's gross income. An individual's gross income. Now, the part that's most interesting to me is that one of the items they list with numbers, this is numerical, is a state tax refund from the previous year. A state tax refund from the previous year. My hat's off to Becker on this, because they're doing exactly what I mentioned in class. Who can remember way back when we were still innocent and naive in the tax area, when we talked about the economic benefit rule? Do you remember the economic benefit rule and what I mentioned with regard to state income tax refunds? Probably goes back to week 2. I said, and Becker's agreeing with me on this question, yes. I said that if you itemized and got a benefit out of a state income tax deduction, then when you get your state income tax refund, you have to pick that up in taxable income. That's true in my case. I'm able still to itemize, although I don't know how much longer this will last. And when I got that state 1099 from Illinois, I had to pick that up into gross income. But if you did not itemize and you took the standard deduction, then you don't. If you do not itemize and you always take the standard deduction, then you do not have to pick up the state income tax refund. You do not have to pick up the state income tax refund into taxable income. You do not have to pick up the state income tax refund into taxable income. Now, these Becker problems say this is a single guy who always claims the standard deduction. So you are not going to pick up the state income tax refund into his income, whereas for me, you'd have to pick it up. I like that. That's a new question that Becker added, and I like it.